Hey folks, I thought it'd be fun to give you an in-depth review on one of my favorite sectors in the entire stock market when we're talking about cash flows, dividends, and passive income, and that of course is the utility sector, only comparable in importance to the healthcare sector in my humble opinion, because nobody wants to flick their lights off or live without energy, right? And in this current geopolitical environment, when we're talking about the war and a lot of people in the US trying to bring natural gas and oil production back home, I really feel like a few of the positions I currently hold are going to excel through the next couple years as this process kind of evolves in front of our eyes, right? Now, in my portfolio, these utilities make up about 14% based off 4 individual stocks of the whole portfolio, but even though it's kind of a smaller percentage weighting of the general portfolio, the dividend income, it's making up about 20% of that entire pie. So it is a very important piece of my income portfolio here, folks. These 4 companies making up that 14% include Northland Power, Algonquin Power and Utility Corp, which is one of my largest positions in the utility space, Enbridge, the most recent add, and then some pure US exposure with something called Southern Company. If this is a conversation you can appreciate in return, I simply ask that you hit that like button, folks, because today I'm just giving you a brief introduction to where they currently sit today. I'm not going to get too involved in the numbers. I don't want to bore you to sleep, but let's focus on the dividends and what these companies give me from a diversification set. First and foremost, Algonquin Power and Utility Corp, guys, currently pays a yield of 4.5%, has been bounding off its lows since I've been buying it, finally starting to see some capital gains from this position since I've been adding it over the last year or two. But taking a look, this thing blows my mind from a dividend standpoint because not even McDonald's can compare to this. When we're talking about a starting yield that's this high already, if we go back basically 5 years to 2017, 2015, or 2016 timeframe, it was paying 10 cents a quarter. Today it is paying 17 cents a quarter. That is astounding. A 70% increase on the dividend side of it. And if we're talking about why I love this company, well, it gives you real great exposure to not only the US and Canada, but it gives you the access to the utilities that I love the most. So let me show you the diversification set. Now, 72% from the regulated side is coming from transmission lines and basically just the electric grid. So basically, say that there's a nuclear power plant generating energy. Well, it needs it to get that energy out to my house. And that's what the power lines are for. And this company has great exposure to that. We're talking about water utilities and treatment facilities, and you're talking about natural gas, but they also have this great renewable side of their portfolio, giving you access to solar and wind projects across the US and Canada as well. I absolutely love this position, and another reason that utilities are so stabilized for income is they're government regulated. It's the closest thing to a guaranteed check you're going to get. A lot of people have issues with these companies because they're highly leveraged with debt, but it's a very costly thing to set up, obviously, right? So it does come from a different balance sheet perspective. But let's talk about Southern Company here. Why do I like this one so much? Well, honestly, it's been one of the first positions in my portfolio. I've been holding this probably for over 5 years now, currently paying a 3.73% dividend yield, 42% gain over the last 5 years. And from that dividend standpoint, guys, not nearly as impressive. Basically, we go back 10 years to 2012 when it was paying 49 cents to today where it's paying 66 cents. You know, really isn't that great of an increase, but we're talking about a much larger utility than something like Algonquin Power because the market cap on this is $74 billion here versus Algonquin's only 12 billion or close to 13 billion market cap. So it's a lot easier for Algonquin to grow than it is Southern Company, right? But the reason I like it is because it gives me exposure to sectors I don't currently own when we're talking about nuclear. Now, this is very comparable to Duke Energy, another favorite utility of the dividend investors out there. Duke is much more leveraged in the nuclear aspect of things, and I think it's going to be a huge proponent of Southern Company's future as they are pushing to get more nuclear power plants online. Now, taking a look, they also give you exposure to coal, something most people don't want to talk about, but it's still a huge power generation for most of the world. A little bit of renewables, and then a huge exposure to natural gas. And if we take a look at their 2021 total energy mix, because it kind of just shows you the updates here, coal has become much larger. Nuclear's came down a little bit, along with natural gas coming down a little bit. So I'm curious to why coal has really taken off in 2021, considering obviously all the political manner around renewable energy, right? But either way, I love this company, and it's going to probably remain in my portfolio for the foreseeable future. So let's talk about Northland Power. This company is one of my favorite Canadian utility stocks for global diversification and pure exposure to renewables with wind and solar. A starting yield of 2.92%. This is literally the first stock that ever made it into my portfolio. My yield on cost is well over 5%. So you do have to keep that in mind because I don't think I'd be as inclined to buy this today for a few reasons. One of the main reasons, guys, is they haven't increased the dividend since 2017 when it went from 9 cents to 10 cents. And on top of that, one of the best benefits of this company, however, is that it pays the dividend monthly. And outside of that, they do give you one benefit that no other dividend stock can really offer you, and that is if you do the reinvestment dividend plan, they actually give you like, I think, a 10% discount on the shares, 5 or 10% moving forward. Something I've taken advantage of, but lately I have scaled this down to diversify a little more because once upon a time it was far too large of a position in the portfolio. But again, the reason I love this is it diversifies me right into the renewable space, because this is the fourth largest company on the planet for exposure to this kind of sector, right? For offshore wind makes up 52% of their portfolio, onshore is 24%, efficient natural gas is 16%, and then utilities makes up about 8%. I absolutely love this company. Will also remain as my my utility sector, one of my utility stocks moving well into the future. I'll probably hold this forever. So let's talk about the last one, the most recent add to the portfolio, being Enbridge. Now, Enbridge is literally the third largest company in Canada, currently paying a 5.97% dividend yield. Has been well bounding off of its lows since oil basically bottomed out sometime in 2020. It looks like it could be pushing back toward its all-time highs that it saw back in the 2015 time frame, but only time will truly tell. Now, the reason I think this one's going to do so well, and the reason I bought it toward these recent highs, is because basically, guys, when we are talking about, this whole idea of Russia being a big problem for the energy supply, right now the US is trying to ship natural gas out, oil out to even other countries so they don't have to rely as heavily on Russia. I think because this company gives me exposure primarily to the pipeline industry, and before I kind of break down the diversification, it's important to mention this is the largest pipeline and basically the transmissible idea of energy. So they basically ship the gas down the pipelines as far as from Alberta all the way down to Texas. They have a lot of pipelines related to natural gas. So it's kind of like a streaming company that gives you a third-party exposure to the oil and gas sector. So I don't have to worry about the margins and the volatility in the oil price, because it doesn't matter what oil costs, you're always going to need to ship it around the country. And the fact that we're not importing as much oil, I think they're going to become very dependent on these pipelines, and only the coming quarters will tell in those earnings reports. But take a look at the diversification set this gives me. So liquid pipelines makes up the vast majority of the portfolio, a little bit of renewables, gas distribution and storage, and then gas transmission. If you live in Canada or Ontario specifically, if you're in the city, go look at the natural gas pipelines. 9 times out of 10, it has an Enbridge logo on it. Before I forget, it's important to mention the dividend yield here has also been insane from the growth aspect, because it already starts out over 5%, which is nuts as it is. But if we go back to 2013, it was paying 31 cents a share, to today where it's paying 67 cents. That's over a doubling in a decade here, folks. But I think all of these companies combined, you can see how they give me diversification to water, transmission lines, natural gas, global renewable energy, nuclear energy, coal. It gives me this real well-rounded portfolio to every sector that matters for power generation. And on top of that, guys, we're talking about insanely awesome cash flow that I will be able to reinvest. Now, I'm not looking to outperform with these stocks. I'm glad that they performed as well as they've had since I've held them, but primarily I just want that high yield, that cash flow ranging anywhere from 3 to 6%. They all balance out nicely to giving me a 4.5%, 5% yield overall. And that is why I absolutely love them. And it's just, like I said, if you're a dividend investor, if you're looking for cash flow today, I would be really closely paying attention to these sectors, because they're becoming more and more prevalently important with the reliance on oil and renewable energy. So I pass that question off to you at this point. I would love to know what you think in that comment section below, but stay cool, stay awesome. And as always, I look forward to catching you in the next one.